Silicon Valley Bank collapsed in 48 hours. Not 48 days, not 48 weeks, 48 hours. A bank that held $200 billion in deposits gone before the weekend. And it almost took the entire banking system with it. On Wednesday, March 8, 2023, Silicon Valley Bank appeared completely normal. Staff showed up for work. Customers accessed their accounts. The stock was trading. 48 hours later, the bank was history. $200 billion in deposits had evaporated, and the Federal Reserve, Treasury Secretary, and White House were in emergency meetings because if they didn't act fast, ATMs would stop working Monday morning. This wasn't just a bank failure. This was the beginning of the biggest crisis the global financial system had seen since 2008. And the most terrifying part? It was entirely predictable. To understand Silicon Valley Bank, you need to know what it was. SVB wasn't a typical retail bank. Average Americans didn't have checking accounts there. Instead, its customers were tech startups, venture capital funds, tech company founders, crypto firms. If you've heard of almost any Silicon Valley company, they had an account at SVB, Roku, Roblox, Etsy, Circle. The model was simple. Tech startups receive venture capital investment, deposit the money at SVB, draw it down as they spend. SVB takes those deposits and invests in safe assets, mostly US Treasury bonds and mortgage-backed securities. Low risk, stable returns. Classic banking. But in 2020, something changed. The COVID pandemic. The tech sector exploded. Remote work, e-commerce, crypto, all boomed simultaneously. Venture capital money flooded into startups, and all that money went to SVB. Between 2020 and 2022, SVB's deposits doubled from $60 billion to $190 billion. What did they do with this massive cash influx? They bought more bonds, billions of dollars worth. But here's where the problem started. They bought these bonds in 2020-2021 when interest rates were near zero, 10-year bonds yielding 1.5%. In normal times, that's a decent deal. But times weren't normal. The Federal Reserve began raising interest rates in March 2022 to combat inflation, from 0% to 5%, the most aggressive hiking cycle in 40 years. And when interest rates rise, bond prices fall. Simple math. If new bonds pay 5%, old bonds paying 1.5% are worth much less. SVB's bond portfolio lost billions on paper, but accounting rules didn't require them to report these losses because they planned to hold the bonds to maturity. Unrealized losses, they called them. No problem, they said. The bonds will eventually pay full value at maturity, they said. But there was a problem. Depositors started wanting their money back. The tech boom was over. Startups were burning cash but couldn't raise new funding, so they were withdrawing from their SVB accounts to pay bills, cover payroll, survive. SVB began selling bonds to meet these withdrawals, but they had to sell at a loss because with interest rates higher, the bonds weren't worth what they used to be. In March 2023, they sold $21 billion in bonds and realized a $1.8 billion loss. They announced an emergency capital raise to fill the hole. That's when the panic started. Modern bank runs aren't like the 1930s. People don't form lines in the street. Instead, they go to Slack channels, open Twitter, and transfer money from their phones. On Thursday morning, March 9th, a venture capital firm sent an email to its portfolio companies. Withdraw your money from SVB, now. The message spread through Slack groups, through Twitter threads, through venture capital networks. That day, $42 billion was withdrawn, 25% of SVB's total deposits, in a single day. In the digital age, bank runs happen in seconds. By Friday morning, March 10th, SVB couldn't meet customer withdrawals. Stock trading was halted. By afternoon, federal regulators seized the bank. Silicon Valley Bank was officially dead. But the story didn't end there, because SVB's collapse triggered a domino effect. Credit Suisse was a 167-year-old Swiss banking institution, founded in 1856, before the American Civil War. It survived 2 world wars. It weathered the 2008 financial crisis. But in March 2023, it collapsed in 2 weeks. Credit Suisse had been troubled for years. Scandals, bad loans, management chaos. But when SVB collapsed, investors panicked. If American banks can fail, what about Credit Suisse? Depositors began withdrawing. The stock crashed. On March 15th, the Swiss National Bank announced an emergency $54 billion credit line. It wasn't enough. On March 19th, the Swiss government forced a shotgun wedding. UBS bought Credit Suisse for $3 billion. It had been worth $8 billion a year earlier. A 167-year-old bank vanished in a weekend deal. And then came First Republic. First Republic was a California bank serving wealthy clients. After SVB collapsed, depositors worried. Withdrawals began. By late March, they'd lost $100 billion in deposits, more than half their total. 11 major banks deposited $30 billion into First Republic to inspire confidence. Again, it wasn't enough. On May 1st, regulators seized the bank and sold it to JP Morgan. $233 billion in assets, gone overnight. One bank in 48 hours, a second bank in 2 weeks, a third bank in 2 months. So what did the Federal Reserve do? They panicked, but quietly. On Sunday night, March the 12th, an emergency meeting was held. President Biden, Treasury Secretary Janet Yellen, Fed Chair Jerome Powell. By morning, 3 major decisions had been made. First, all SVB depositors would be made whole, even above the FDIC insurance limit of $250,000. This isn't a bailout, they said. This is preventing systemic risk, they said. But in reality, it was a bailout. Wealthy tech investors were rescued. Executives, they were fired but faced no penalties. Second, the Bank Term Funding Program, BTFP, was introduced. Banks could borrow from the Fed using their bonds as collateral at face value, not market value. So if your bonds lost 30% of their value, the Fed would bail you out. Risks socialized, profits privatized, just like 2008. Third, swap lines. The Fed provided liquidity to the European Central Bank, Bank of England and Swiss National Bank, so they could rescue their own banks. Global contagion was prevented, temporarily. Monday morning, markets opened. Panic subsided, ATMs worked, disaster averted, but was it really? After 2008, we were told the too big to fail problem was solved. The Dodd-Frank Act was passed, stress tests were implemented, capital requirements increased. Never again, they said. But here we are, in 2023, doing the same thing again, rescuing depositors, letting executives walk free, spreading risk to society. Moral hazard is still here. If you're too big to fail, you can take whatever risks you want, because the government will save you. SVB executives didn't go to jail. They kept their bonuses. They'd sold stock before it crashed. Credit Suisse executives? They left with golden parachutes. First Republic's CEO? He retired. Who lost? Taxpayers, small bank customers, and anyone who believed in the integrity of the system. But the bigger question, could this happen again? The answer, yes. Because the underlying problem is still there. Many banks still carry similar risk. Low-interest bonds, unrealized losses. The FDIC estimates $620 billion in unrealized losses across the banking system. That's the reported figure. The real number is probably higher. Worse, the next crisis could come from a different source: commercial real estate. Post-COVID, offices sit empty. People work remotely. Companies downsize office space. Commercial real estate values are falling. And who lent money for these buildings? Regional banks. If commercial real estate collapses, the SVB crisis will look small. SVB collapsed. Credit Suisse died. First Republic vanished. The system wobbled but remained standing, for now. The Federal Reserve and Treasury intervened in panic. Depositors were rescued, executives escaped. And the underlying risk is still there, waiting for the next panic. This is how economic systems die. Not all at once, but crisis by crisis. And each crisis requires a bigger bailout than the last. In 2008, we rescued 2 big-to-fail banks. In 2023, we rescued 2 connected-to-fail banks. In 2030, who knows how many banks we'll have to save? The question isn't, when will the next crisis come? The question is, when it does, will we still have the money to bail it out? Because history teaches us one thing: every bailout makes the next crisis more likely. and one day the bailout money runs out.